If you've been taking trades that stop you out early just for the market to reverse in your favor, chances are you probably don't know where liquidity is resting at. In this video, I will simplify how to identify and use liquidity in real time, and then I will show you how to implement it inside of your trading strategy to become consistently profitable. Now first, let's go over how the market actually works. So like any market, we have buyers and we also have sellers. In this photo I have here, I have a Bugatti. So let's say that this Bugatti is being sold by a group of sellers, like your local car dealership, for this price. Now what if these people who want this Bugatti say that the price is too high? What's gonna happen to the price of that Bugatti? Automatically the price has to fall so that the market can be back inside of equilibrium, because when the price is too high, nobody is going to be willing to buy at that price, so price has to fall. Think about it like this: when there are more buyers, price has to increase, but when there are less buyers, price has to decrease until the market decides on the correct price. See, price doesn't just move from left to right. The market moves in ranges based on who is buying or selling. But when you're on the charts, you might see a chart moving from left to right, but that's not the truth. The real actual price is moving just up and down all day between buyers and sellers. The candlestick charts or any chart is just a representation. In my example I have here, let's say that we have buyers on this side and we have the sellers on this side for that same Bugatti. Let's start from right here. You can see that the Bugatti is worth $2 million. How many buyers do we have here and how many sellers do we have here? There is not enough sellers to stop the buyer. There's too much demand for this Bugatti. So what's gonna happen to the price? It's gonna keep on going higher until that demand decreases, until the market can decide a good price for that Bugatti. Right now, the demand for the Bugatti is greater than the amount of sellers. But what does this even have to do with liquidity? It is important because let's say there was a group of people who only bought this Bugatti to sell it at a better price. Basically, they wanted to flip the Bugatti and make more money flipping it than just holding on to it. See, the people who bought right here, their Bugatti is now worth $2,500,000 once the price gets up here. Because as we said, because there's more demand, there's more buyers than sellers, price has to rise. Now, Bugatti is now worth this much. So when the Bugatti is worth this much, what if these buyers became sellers and sold back here to make a profit? Look at how many sellers there are to buyers. What's gonna happen now? When there's an ample amount of supply, price has to go down. And who's making money? It's the people, like I said, who bought down here and now over here selling it and making an ample amount of money. Now that the supply is high, these people as well don't have any other choice but to agree to the prices of these people, because these people as well, they bought down here but they don't want to sell, so they're locked in right now. But their Bugatti is now depreciating and they're technically losing money, while these people who are now sellers are making all of the money. So now we will go over where liquidity is actually resting. First, we have our previous day high or our previous day low. When we look at this candlestick right here, this candlestick is not the full picture. This is just a daily candlestick. This previous daily candlesticks was a red candlestick. So what do we have right here? We have the high, the open, the close, and the low. Why is there liquidity at the high and the low? At this price right here, we can see that buyers tried to push price higher to this level, got beaten out by the sellers, and price went all the way back down. Their stops are now above this high. There's liquidity right there. Same thing with the low, where sellers try to push price lower down here, but now they got beaten out by buyers at the close, where their stop. They're right here as well. Now let me show you guys a better example by hopping on the charts. So let's go to gold and then let's mark off this day right here. So we have our high and then we have our low. Now we're on the 15-minute time frame. We're no longer on the daily. This whole entire day's price action is a representation of that daily candle. Where is liquidity resting at? Right above the highs and the lows. And then we can see, we come into the next day, we see that price almost tests these lows, but buyers come back in and then we go higher, barely testing these lows on the next day. So we know that there's liquidity sitting right above these highs and lows. Our next type of liquidity is session-based liquidity. So if you watched my previous videos, you probably heard me talk about this concept before. Our 3 sessions that we mostly primarily use and look at are Asia, London, and New York. So right above the highs and the lows of that specific session, there is liquidity resting. Why? Because each session has a different group of participants available who trade during that market. Usually Asia is a consolidation or lower price, lower volume move. London usually is a little bit more volume, and then New York usually has the most volume, especially when we're looking at these. So there is, when we talk about session-based liquidity, there is liquidity above the highs and the lows. Now here's a chart example just so that you guys can understand. In this black, I have Asia range. In this lighter color yellow, this is our London opening time, and this is our London session. And then in this color, we have New York session. Basically, all of this is New York. So if we look closely, we mark off our Asia range, which is right here to right here. And then during London, what do we see? We see a push above the highs of the Asia range. And then what we reject, even if it's for a little bit, we start coming back down. Why? Because right above here, there were probably a bunch of sell orders above that Asia range. And then what do we see during New York? During New York, we see a large manipulation candlestick. This was a news candlestick. But where do we go to? We take out Asia low liquidity and we take out London low. And then where do we push to? We push past London high, which was right here. And then we just keep going higher and take off. At the highs and lows of every single session, there is liquidity resting. The next important level of liquidity I want to talk about is our 4-hour through weekly time frame liquidity. So when you look at a chart, you probably see sometimes that price on the higher time frames is drawing towards a certain level, and maybe you have support and resistance marked off. Price blows through that level and then goes higher on the higher time frame. So these levels as well, the same thing occurs where price has liquidity resting right below these stops that were placed right here and these stops that were placed right here. So for price to keep moving higher, it has to push that price down before we can get the fuel that we need to keep on going higher. So now I have an example of this on NAS 100 that happened recently. A couple weeks ago, we had this 4-hour trend that we were in. Where's liquidity resting at while we were inside of this trend? Right below these lows, these lows, these lows, and these lows. So when price comes back down the next week, we target all of these lows. And what happens each time as we go further and further and further? Price eventually rejects, takes all of this liquidity. So each time price takes out a low just to move higher inside of the higher time frame, because price loves these areas because there are more orders resting on these higher time frame lows. Same thing on the daily, we have these 4 hours, same thing, price came down, took it all out, and then moved further higher. Even right here, price came all the way back down to take out this low and test these buyers from all the way here, take out all that liquidity just to move higher. Now we're going to go into more strategy based liquidity. If you trade support and resistance, supply and demand, trend lines, Fibonacci, a whole bunch, basically every single strategy, you probably have been in a circumstance where the market takes you out by the pip, or by the tick, reverses, and then moves inside of your favor. So this is price hunting down liquidity, not hunting down your stop, but a pool of stops that are more than likely inside of that area. So when I mean support and resistance liquidity, I mean basic support and basic resistance. We have our box, this is resistance up here, and then we have support down here. Price is coming up, coming down, coming up, and what do we see? We see price poke its head above this high right here, and then who's getting in? Breakout traders, support and resistance. You probably think, oh no, this is now supposed to be support level, and then you get in as well, and then what does price do? Price comes back down and is now using you as fuel, and then takes you out and keeps going lower when you thought that price was about to start buying at this level. And not just you, a whole bunch of other participants as well. Next, we have our trend line liquidity. A trend line is when we have price moving inside of an uptrend or a downtrend, and you draw a trend line right here, but then price breaks that trend line, takes that liquidity, and then either keeps on breaking it lower, or we see price go higher with it. The whole entire entire trend line was liquidity. Next, we have a very important type of liquidity, supply and demand, or SMC liquidity. Now, I've been trading supply and demand basically since I came into these markets, and I've seen different types. Price reacts to supply and demand levels and what goes on. But a common theme that I see, especially now, is that you might have a 1 hour demand level. Price breaks structure and everything. It breaks all these levels. And what do you expect price to do right here? Price should bounce off this level and keep on going higher. So maybe you put your risk to reward or stop loss right here, but price then moves lower, invalidates your zone, and then moves higher. For this example, I have a fresh example that happened on Wednesday. We can see that this was a demand zone. Price broke structure and everything, and we're with the trend. What do we see happen? This was CPI. If you were thinking, oh snap, price reached into this demand after CPI, I should probably buy here. You put your risk to reward right here. And then what does price do on the next candlestick? It takes you out in all of your liquidity. All of this resting liquidity right here, all these participants who got in on the first push, price takes them out and then charges up forward and leaves you behind. So this is just another example of liquidity. So now that we have gone over the different types of liquidity, you have to go over how does price actually react near these levels. We can either create a liquidity sweep or a liquidity run. So price comes near your level of liquidity that you've marked off. This is what we mainly see a lot of the times. Price tests this level and then comes back down. Versus when price comes up to your level, might reject for a little and then keeps on going higher. So these are the one of two things that can happen. So on this day, which was just Tuesday, we have Asia high right here, and we also have London high. But what do we see price do during London? We sweep liquidity, which is the Asia high, but we just keep on running. Same thing inside of London session. In New York, we come into New York, sweep liquidity, reject for a little bit, but then keep on running. If you were live trading during this time, once we swept, there was a little bit of an inducement, but price didn't fully reject and make that move lower. It just kept on running higher and higher and higher. So this is an example of a liquidity run. On this example, we have an example of a liquidity sweep. So here we have our London low, 8:30 open, takes out this liquidity sitting at London low, sweeps it, rejects, and then goes higher. So on here, we just didn't run and keep going lower. We swept, rejected, and then started going higher. Now after this, we have to understand the entire liquidity cycle. So now we understand where liquidity is resting at. We understand how the market actually moves. We understand how price reacts once it gets to liquidity. But how is liquidity actually created? Because there's an entire repeatable cycle that happens on different pairs every single day, all of the time that liquidity is made through. See, liquidity is like cause and effect. Think of the market in terms of cause and effect. Things are random. Random things do happen, but there's also a cause and effect behind of the market. Liquidity can't just be taken out without there being an engineering of it first. So the liquidity cycle is basically a name that I got from either, you can call it the power of three, which is ICT's version or name for it. You can compare it to Wyckoff theory, which dates back all the way to the 1940s about how the market actually moves. But first, we have an accumulation, manipulation, and then distribution. And I'm going to go through each one of these in depth so that you can understand. So during our accumulation phase, I have an example of gold right here is our Asia session. During this time, price was accumulating. So even though we were moving up a little bit, price was moving inside of a range. We would consider this low volume price action. Price isn't really like expanding quickly. During this time, participants are engineering liquidity. We can say that big money, smart money, or bigger participants, market makers, are hiding their actual orders inside of this range. And then we have manipulation. So during this time, participants are letting price go lower. These market makers inside of this session made individuals think that price was actually going to go higher. So everyone inside of this session was like, oh snap, price is accumulating, we're going higher a little bit. It made it look like this was the actual trend. And this is the trend. If we would have went to the higher time frame on this day, we would have saw that gold was actually very bullish. So they made these traders think that price was going up. Then what happened next? Manipulation. Price starts selling aggressively to the downside inside of the next session. Both two sessions inside of London and New York, we see that price aggressively sells down, takes out all of this. So all of these traders who were buying up here, all of their orders, are now the fuel for the market moving lower. We are dealing with these participants now from Asia. They're locked inside of their trades because a lot of them, when they got in, they probably put their stop losses right below here. So they're still inside of this trade while these participants are now sellers and selling price down aggressively. And next, we have the final phase, distribution. So during that distribution phase, we got all of these sellers out. All of these sellers are out, and these sellers now who were inside of this big move, they probably think that price is going lower. They're like, oh, we're selling now, so we're going to get in too. But during that distribution phase, we see that price now reverses and goes inside of the direction that it wanted to go inside of the first place. So if we go back to our market auction theory that we said earlier, this accumulation, manipulation, and distribution is exactly like the example we just showed, where the sellers who were once buyers now become sellers and push price back down. It is the same thing, just on a chart. We have buyers instead who made price look like it was accumulating, going higher. They manipulated all of those traders out just for them to get back in and move the market higher. Now let's go over the liquidity cycle and sessions. So you've probably already heard me relate this entire cycle to session, but let's go over it again. So during our Asian range, we have accumulation. Price is accumulating orders back and forth. This Asian range is less volatile. There's barely anything happening during the Asian range most times. We can sometimes see that it's trending, but even that is just most of the time, that's just a way of bigger participants to make people think that Asia is a representation of the entire day, when it's not. Next, we move to London. London is usually a manipulation of Asia, either the highs or the lows. So we usually see a manipulation during London. If we don't see manipulation during London, we see it during New York. So during New York, we either get distribution or a manipulation to the side that price actually wants to go to. Now we can see this happen a lot of times on many different pairs. We see accumulation, manipulation, distribution. It is a rinse, wash, repeatable pattern. Not even a pattern, but a way in which the market moves. We have price moving lower here, and then we have manipulation down here, and then price moves higher. Here is another example. We have accumulation in Asia. Asia's orders make it look like we are selling or in consolidation for the day. And then what happens? Manipulation right inside of London Open. Next thing, distribution. We distribute all the way to New York, and then we end up going all the way up here. Same thing happens on this day as well. And then London again. We have manipulation of Asia, and then we start distributing higher, higher, and higher. So now that you understand how it's made, where's liquidity resting at, what happens when price touches liquidity, and especially how the market actually moves, now we can create a simple yet effective trading plan. Now I'm going to go over each one of these steps step by step so that you can implement this inside of your trading and make it better, or you can just follow this trading plan if you don't already have one. If you already have a trading plan, I just suggest implementing some parts of this, but don't start all over from scratch. But if you don't have a trading plan and you're basically just gambling away, I say use this trading plan to get you started. The two sessions that we're going to be focusing on are London and New York. Why? Because these sessions have more participants. It's easier to catch trades. So in our London session, we're going to be focusing more on GU, EU, or gold. In New York, we're focusing mainly on indices or gold. So we want to trade during the first hour of New York or London session. Why do we want to trade during the first hour? Now, moves can happen outside of that first hour, but we want to choose the most high probability time for price to move inside of our favor. Time is very, very important. Who do you think is trading at the same time as session opening? We have Wall Street, we have prop traders, we have everybody is trying to get in during that first session opening. That's when the most manipulation is going to happen. If you get the manipulation of the day right, you're making money because you're in with those people. During that time as well, we have the most inefficiency inside of price. Inefficiency is important because that's how we make money as traders. So if we could capture that little time frame of inefficiency, we'll be able to make more money from the markets. Next, we want to be trading with a higher time frame trend. Higher time frame trend trading is very, very, very important because yes, we can trade the power of 3, the liquidity cycle any day, but we want to align our probability with the higher time frame so we can catch the bigger move expansion. If we just trade the lower time frames against the trend, eventually we're going to get caught up and you might not get the full move that you actually want. If we're trading with a market that's trending and we're with the higher time frame trend, we're with the people who are moving the market, then or more than likely our probabilities are more inside of our favor. So as we can see here, we see that on this day price was ripping downwards, price was selling. So all this time when we are selling, I'm selling. I'm not looking for any buys because market structure is telling me that we are selling. Day is inside of this range right here where we were selling off. This was one of the days that I sold off and made profit from the market. Next, we want to wait for manipulation to happen. So on this, we're trading NASDAQ or NAS 100. So we're waiting for New York. We're not trading in London. We're trading New York session. So next week, we're waiting for manipulation. Right or at or near 8:15, 8 o'clock, the open, near 8:30. Asia, we see the range. There is liquidity, like we said, right above the highs and the lows. But since I'm selling, I'm looking for manipulation of the highs. Next thing you know, during London, we take out Asia high, but there's still liquidity above London high as well. Even though it's just one candlestick, there's still some liquidity right here. Next, we have the New York open. We see manipulation straight off the bat. That's not it. The next thing we need is extra confirmation. So we can literally get in. And sometimes I do get in after I see rejection. Like this after manipulation. That's enough for me to get in sometimes. But sometimes you need extra confirmation. Extra confirmation aligns even more probability on your side. So we would not get in straight off the bat. We need to see a market structure shift or a coast. We need to see a change of character before getting in the markets. So right here we can see that we were buying. Where's the last structural high? This is on the 1 minute. It was right here. So we don't get in until we see that breakdown. We put our stop loss right above or under the origin. So here we put it above because we're selling. We put our stop loss right above that origin. And then what do we aim for? We aim for a mechanical 1 to 2 risk to reward. Now you're probably asking why a 1 to 2 risk to reward. See, when you're a beginner and you're just copying off the strategy, you just want to see a little bit more consistency. And targeting a 1 to 2, you only have to be profitable more than 35% of the time to become a consistently profitable trader. That is literally it. That is it. You just have to be profitable more than 35% with the 1 to 2 in this. So having that 1 to 2 mechanically will help you see price and you're going to get used to it. Now I'm going to show you guys an example of this happening back tested real time. So we have Asia high, Asia low. Then we have London. Our higher time frame trend is bullish. If we go to a higher time frame, we're definitely bullish. What do we see? See accumulation over here. We haven't manipulated Asia low yet though. Next thing you know, New York opens and we have manipulation happen. But we're not yet ready to get in. Now in this example, I went to the 2 minute time frame just because it wouldn't let me go to the 1 minute. So we have already manipulated, but we're still waiting because we don't see a really good shift. Now you could have said this was a shift, but I wouldn't really count that. I kind of want to see a shift and then a follow through in intent. So this shift right here is better for me than this one was. This was an inducement and this was the actual shift. But you might have gotten stopped out on here and that's okay. You can get back in on here. You put your stop loss at the origin. Notice we would have gotten in as soon as this break right here. And we aim for a 1 to 2, which is also right above London high. And then what do we see happen? We see that price actually breaks, comes back, literally comes back. We can see that this point right here was a very important point because price can't even push back downwards. We see that there are no more sellers left to push back down. We already had the manipulation move. And then we just see price skyrocket off to take out these highs. So if you missed this entry and price came right back down here, you could have gotten back in, price goes higher. So that's basically it on liquidity concept simplified. If you guys like this video, make sure to leave a like, comment, and also subscribe. I post every single Tuesday without fail. Or if you need more help, I have a free Discord down below in the description. You can go in there, private me directly if you have any questions on this system. That's it for this video, and I'll see you guys